Ladies and gentlemen, welcome to our latest breakdown of Boss Economics World, brought to you by yours truly. And today, we're dissecting none other than the latest monthly U.S. Consumer Prices Index, CPI, report, expected to prompt yet another flurry of second-guessing by the folks who are supposed to be managing one of the largest economies on Earth. Yes, I'm looking at you, Federal Reserve. Let's begin with the basics. Every month, we get these CPI numbers, which are supposed to be a measure of how much consumer prices are rising. It's these numbers that the Federal Reserve obsesses over, trying to prevent runaway inflation with the biggest sledgehammer they have, raising or slashing interest rates. But here's the joke, we're now into our third month of what they're very hesitatingly referring to as firm underlying inflation. You know, the kind of inflation that doesn't include volatile food and energy prices. Too bad that's exactly what most of us are actually paying for every day. So, what are they telling us? Well, the market expects a rise in core CPI of about 0.3% for October, and the overall CPI to rise by 0.2%. On the surface, this sounds tame, like maybe we're inching closer to the Federal Reserve's 2% inflation target. But let's not get too comfy. The Fed, throughout 2023, adopted a more modest approach, cutting rates by a quarter point here, half point there. And now, they're scratching their heads, debating whether to cut rates further at their December meeting. Investors, poor things, they're always wrong in guessing what the Fed will do, have already slashed their expectations for a rate cut in December from 80% to 60%. Why? Because every time we think inflation is showing signs of a slowdown, we get hit with another bump in the data, throwing everything into disarray. It's like watching the US economy do the cha-cha, a step forward, a half step back, a little shimmy to the side. The real problem is, this constant uncertainty is causing more harm than good because monetary policy, that trusty tool we've leaned on to keep inflation in check, no longer seems to be having the impact it used to. Now, you see, the CPI isn't just one number. It's a basket of prices, housing, transportation, healthcare, you name it, all wrapped together to give the public an illusion of choice when we talk about inflation. But this house of cards stands shakily on a few key pillars, not least of which is owner's equivalent rent, OER, the single largest component of the CPI. Here's where things get tricky. OER inflation was accelerating across the summer, defying expectations. Investors were hoping it would slow down, but even after a bit of relief in September, experts warned that this measure might just creep back up again in the latest report. Look out, people, because this isn't income from your portfolio, this is rent. The thing sucks up the bulk of most people's paychecks. And what's driving rental prices now? Hurricanes. Yes, that's right. Hurricanes Helene and Milton didn't just ruin coastal towns, they're now distorting the inflation numbers too. Displaced people are crowding into hotels, driving up lodging costs, which we ironically seasonally adjust as if we can account for natural disasters. You can't make this stuff up. Takeaway, with natural disasters driving up key CPI components, relying on seasonally adjusted CPI readings to deliver an accurate picture of inflation is a joke. You know what's one of the biggest components of the goods category in the CPI? Used cars. Ironic, isn't it, that in a country with such an obsession with shiny new things, the price of used cars is one of the most critical factors here. Deflation in used car prices had been one of the few bright spots in an otherwise worrisome inflation story. For 14 of the last 16 months, the category posted declines. But that's changing, auction prices for used vehicles are rising again. According to Wells Fargo's numbers, we could see the largest monthly gain for used vehicles in over a year. Thanks to Hurricane Helene, and its belligerent cousin, Milton, several thousand vehicles were trashed, leading to a sudden surge in demand for replacements, and voila, used car prices are on the rise again. This shouldn't surprise anyone at the Federal. But wait, here comes the official position from Barclays economists, natural disasters and seasonality adjustments are to blame once again. Higher demand from displaced families, combined with new season factors, seems just too tall an order for our method of adjustment. The takeaway? Let's not fool ourselves. While the Fed tries to pin down inflation with precise monetary actions, uncontrollable events like hurricanes are wreaking havoc across the numbers. Here's the part where we have to ask the serious questions, is the Federal Reserve really in control? While we love to sit back and admire the finesse of a well-timed rate cut, the ugly truth is that the Fed's main tool, adjusting interest rates, is starting to look as outdated as running a Windows 95 operating system in 2024. Let's look at the facts. The hurricanes may have created temporary distortions, but long-term structural weaknesses are abundant. 1. Supply chain disruptions. No, we can't just blame COVID anymore. Global supply chains have not returned smoothly to pre-pandemic levels. Whether it's semiconductor shortages, raw materials logjams, or complexities in global shipping, these disruptions are ruining the supply side's ability to produce at reasonable costs. 2. Core goods prices. Despite improving supply chains, goods prices have declined in only 9 of the last 16 months. Simply put, inflationary pressures continue to simmer even in the face of improved logistics, and these are issues that simple interest rate cuts won't solve. 3. Labor market pressures. The demand-side fire is fueled by a tight labor market, where wages are still rising faster than productivity. As economists like Larry Summers have pointed out, tight labor markets and robust wage growth can create a permanent floor on inflation that the Fed can't control with mere rate tweaks. 4. Geopolitical tensions. The shift in global geopolitical power has also added complexity to inflation forecasting. The US-China trade tensions, now on their 5th anniversary and counting, continue to put upward pressure on production costs, as tariffs and supply fragility reset global trade patterns. Don't forget, the 2024 US presidential election is looming. Politicians love to dance around economic policy in election years like it's a game of musical chairs. Voters hate high inflation even more than they hate high taxes. And so the meeting in December is going to be an excruciating balance of political maneuvering and economic guesswork. The Fed doesn't want to be seen as out of touch, but how realistic are they? With those elections shaking investor sentiment, the economy could tank further. And all while inflation remains high. Heads I win, tails you lose. In truth, the Federal Reserve is playing a high-stakes game that nobody really wants to admit they're losing. Headlines every month on CPI numbers feel less like informative updates and more like a chronic sense of whiplash. One quarter inflation's coming under control, then suddenly inflation rears its head again. Micro adjustments in interest rates solve none of the real problems, namely global supply chain struggles, hurricane-driven inflationary spike risks, vehicle replacement demand ripple effects. At the end of the day, the whole system is tottering, reliant on outdated monetary policies while the core problems of economic structure, global dependencies, and natural shocks are all getting worse. The CPI, the Fed, and even the White House may have something in common, the illusion of control. That's it for today. We'll continue breaking down the economic incompetencies of our era until somebody, somewhere, cracks open a textbook and reads what happens when policy refuses to grapple with reality.